All right, welcome back again. We'll get to that next screen. So another term you need to know for this chapter is alpha. Alpha is the measure of excess return over what's expected from beta. This indicates the fund manager's skill. So in order for a mutual fund, which would be operated by a fund manager, in order for that fund manager to add any value to his operating of an investment, he has to add return. The extra return that is over and above simply what the market would return is considered alpha. So let me give you an example of if the stock market in general, let's call it the Canadian stock market in general, is expected to return 5%. If a Canadian mutual fund returns 7%, you would say that that fund manager has been able to add 2% of alpha to the fund. So again, it's how much return is over and above what's expected from the market in general. If you were to simply take or buy the overall market in general instead of the mutual fund, is that mutual fund able to add any alpha, any more expected rate of return? So let's talk a little bit now. We've talked a little bit about volatility, mostly in regards to the general point of volatility and focusing a lot on stocks. But there is also volatility in bonds. I talked a little bit in the previous chapter what happens to bonds during interest rate movements. So we like to remind you that the value of a bond is very sensitive to interest rate changes. And the way the price of a bond or the value of a bond changes is in the opposite direction to what interest rates are doing. Again, interest rates moving up means the value of bonds in general will be going down. Conversely, if interest rates are decreasing, typically the value of bonds will be increasing. The example here says that, the other thing that we have to remember is that the duration of a bond has a very important factor in how much price of a bond is affected by interest rates. What we mean by that is that duration is the length of a bond. So the longer duration, the longer a bond is, the more it will be affected by interest rate changes. So if we compare two different bonds with two different durations, say bond A has a 10-year duration and bond B has a 5-year duration. If interest rates were to increase, the bond that has the longer duration, the longer time frame, that 10-year bond is going to be affected more than the bond that has the 5-year duration. So the two things to remember when it comes to bonds and volatility: the price of a bond, the value of a bond, works or goes in the opposite direction of interest rates. And the longer a bond compared to a shorter bond, the longer the bond is, the more sensitive it is, the more price will change when interest rates change as well. Okay. So, and other factors. So, higher coupon. A higher coupon, meaning a higher interest amount, will have less or lower volatility when interest rates change. Like we just mentioned, longer maturity or longer duration means that it will have a higher volatility. Interest rates will affect it more so. And again, interest rates, inverse relationship with bond prices. So, with all this talk about risk and return, we have to talk about diversification and how that affects risk. What does diversification mean? It means spreading your investments across different companies, industries, asset classes, and geographies. We want to invest in many different types of companies that work in all different industries and that exist all around the world. We don't want to simply just invest in oil and gas companies that are in Canada. We want to invest in multitude of different companies and industries around the whole world. How do we do that? Part of what we look at is correlation. Correlation measures how an asset moves together. So if we have two different investments and they were perfectly negatively correlated, that would be the best diversification possible. So let's back that up a little bit. If you have two investments that are perfectly correlated, they will move in tandem. They will be exactly the same. That will give us no diversification. They will go up, they will go down in the exact same order. What we are looking for is to invest in different investments that will go in different directions. When one might be performing poorly and declining, another investment might be increasing. So if two investments were to work in exactly the opposite direction, that would be considered perfect negative correlation. And that would give us, again, the best diversification benefit. There is research, economic research, that does prove that after 32 securities, 32 different stocks, 32 different investments, added to a portfolio, any additional diversification has little benefit. So again, know this for the exam. After 32 securities, added diversification has little additional impact. Okay. So investment strategy decisions. Asset allocation. What do we mean by asset allocation? It means that we're choosing different asset classes, different investments, different investment types. Stocks being one type, bonds being another type, money market or cash being another type. So asset allocation. How much of a portfolio do we assign to stocks? How much of the portfolio do we assign to bonds? How much of a portfolio do we assign to a cash position? This is actually the most critical decision in portfolio performance, and it has been proven that the biggest factor in determining a rate of return for any portfolio or any mutual fund is going to be the asset allocation, not necessarily the specific investments within it, but simply just the asset allocation. That'll have the biggest factor. There will be other things that factor in, but the biggest single factor to performance in a portfolio is asset allocation. Sector weighting is another decision. Which industries do we focus on? How many do we focus on? Do we focus on all industries? Do we shift from one industry to another? That is a big factor in deciding portfolios. The term strategic allocation refers to the long-term mix plan that guides portfolio management. That means we're going to pick an asset allocation from the beginning and not vary too much from that for the long term. If we pick a completely balanced portfolio that might have 50% in stocks and 50% in bonds, a strategic asset allocation would see that we remain at 50-50 throughout the portfolio's lifetime, or at least within a very close proximity to it. We will have to consider security analysis. When it comes to portfolio management and portfolio creation, there's two types of security analysis you'll have to know for the exam: fundamental and technical. So fundamental security analysis analyzes financial statements, the economy, the management, and different mathematical ratios. Technical analyzes historical price patterns and investment behaviors. So again, fundamental deals more with a specific company, how it's performing, what the numbers look like, what the management's like, and how the economy is performing within that security. Technical analysis simply analyzes price patterns and investment behaviors specifically. So again, the key takeaways for this chapter for the exam: know how to calculate and interpret returns, basic geometric portfolio. In order to get a better understanding, make sure you watch, note, and understand the videos that will be also linked in this chapter. Understand risk types and volatility measures like standard deviation, beta, and duration. Know bond behavior in response to interest rates. Master the concepts and benefits of diversification. Understand the importance of asset allocation, and be able to distinguish between fundamental and technical analysis. Again, like I always say at the end of every lecture, you are responsible for the entire chapter. Read it from start to finish, study from start to finish. Watch the videos that are also attached to this lecture. They will break down further some of the math and some of the ratios that you will need to understand for the exam. See you next time.